So today we are taking a look at the trading performance from one of our customers. He asked us to take a look at his Edgewonk trading journal and get our opinion and what he should focus on going forward. So we're doing that. He is profitable with a return of 9%, 43% win rate, and a reward to risk ratio of 1.3. The profit factor is 1.2, which means that although he is profitable, he is not profitable by a big margin. And you can already see the Edgewonk score is showing that. It's yellow, which means that although he's profitable, this could change any time. And the main reason is here the low reward to risk ratio, 1.3. Although it's above 1, which is a good start, ideally you want to get this up. 1.5, 1.6 and 7 is where you get into an area where you can become profitably very comfortably. Below 1.5, there's a lot of noise on volatility. And you can see when we look at the equity graph here, there's a lot of up and downs, a lot of back and forth. And this is definitely something that a trader should focus on. So let's find out if there are ways in his trading how we could improve his performance and his strategy. So let's go to his chart lab. And the first thing when we want to look at reward to risk ratio is we want to ask the question, is he leaving money on the table or is he executing his trades optimally when it comes to letting it run? Because that's typically where there's a lot of improvement and potential. So we can see in the trade management graph, the actual performance as shown here at the bottom, 10.29, potential performance 22. And the difference between those two is 11.72. You can see we have a red negative trade management feedback box here. And this is showing you that there is some problem in your trading and you are somehow mismanaging your trades. And in most cases, it means cutting winners too soon and letting losses run too long. You can see whenever the green is above the blue line, this will give you this red trade management feedback box. And it's also a negative trade management effect here. And this is a very important, a very, very good finding, though. This has just recently started, whereas in the past, the two lines more or less move parallel. You can see there was a dip early on in the trade management graph showing you here. At that point, there was some mismanagement. This is where the two lines separated. Here he made some errors. Then over the next 60 trades, 70 trades, he did well. The two lines moved in parallel. But then here, for the last 10 trades, there was an issue. And here he recently started mismanaging his trades. That's definitely something that he needs to work on and be aware of. Because this could double his performance, right? He's going from 10 to 22 R, which means double the performance that he's currently seeing. So that's a very, very good first finding here. And it shows that he needs to analyze his trade management. And he should trust his initial process. But let's see if we can find more. We're going to the performance by time. We can see Monday, Tuesday, Friday, he is profitable. Wednesday and Thursday, he is underperforming. When we look at Thursday in particular, we can see this is his most active trading day. We can see it here, 27 trades, whereas typically he has between 15 and 18. So this is significantly more trades that he's taking on Thursday. And Wednesday here, you can see it as well, underperforming. So let's see what we have here. Let's go to the hour of the day. And this is something that typically you don't want to see. It shows that there's trading activity pretty much around the clock. And just double checking, holding time shows that his holding time is typically below a day. So he is a day trader. You can see he is on average holding his trades very shortly. So we can definitely take a look at the performance by time. And typically as a day trader, what we have seen pretty much all the time on profitable day traders is that you have a very well-defined window where you're making most of your money and you then ignore the rest. Here it seems like somewhere between 10 a.m. And this is probably the broker time, between 10 a.m. and then here 8 p.m. This is his most active trading time, but he is trading here pretty much around the clock, right? You can see that from from midnight to 9 a.m. there is trading activity. And what happens is that often this can deplete your mental capital. When you're sitting in front of the charts all day, you're going through charts and timeframes and looking or hunting for signals. What happens is that when traders then reduce their active trading time, often they see a huge improvement also in just their overall quality of their trading. So this is another tip. Let's take a look at only Thursday trades because that's where he's trading so much and he's losing a lot of money. Thursday trades, and then we only want to look at when he entered those trades. And yeah, you can see he is trading pretty much around the clock on Thursdays, starting at midnight, going all the way until 8 p.m. Yeah, I think this is just a very good sign of overtrading, a very clear sign of overtrading. And that could be a potential issue here for why Thursdays are not performing. Let's bring in Wednesdays as well. And yeah, you can see as well, around the clock trading here pretty much on Wednesdays and Thursdays. Let's, by comparison, look at only Tuesdays. Is there a difference? Yeah, you can definitely see there's a huge improvement. There's one trade at 9 a.m., a few here around 12 and 11. But then here the majority of his trading and the majority of his profits is coming from this little window here. And that's it's a very good finding, another very good finding. And we have already seen it here that the majority of his performance is coming from those few hours of trading. So another very helpful finding for this trader to improve his trading process, streamline it, and this will feed back into his trading quality as well. Let's take a look at his setups. He has a bunch of setups, 10 setups overall. Typically for a struggling or new trader who is just building his profitability, typically you don't want to have as many setups because for each setup you have different rules. You're typically following different or using different tools and parameters, and juggling all those things in your head and trying to do a good market prep, a good post analysis, and staying on top of everything while the market is moving is just very, very hard. So we always recommend in the beginning, reduce the amount of setups. He has a very good sample size now, so he might be able to cut a few. Mean reversion, for example, 20 trades. That's a setup where he does have a very good sample size. 20 trades out of 95 trades. So 20% of his trading activity is coming from this setup, which is currently not working for the trader. He could remove a lot of noise from his trading once again and just simplify it. And what we have seen time and again in Edgewonk is just having fewer setups, just like trading fewer hours, and just less is more. And this is really the theme if you've been following our videos over the last few years. When we look at those journals, less is always more. The trading quality always increases, the noise is decreasing, and you just overall will have a better performance. Let's look at exit analysis. And at first glance, this looks absolutely messy, but let's dig into this because there is something absolutely fascinating that could change this trader's performance and whole approach. So what we're doing here is we are going first here to the winning trades. So we only want to look at the winning trades. And this is absolutely fascinating. So let's decode the numbers here. First of all, when we just look at the bars, what do you see? Of course, the green bars, well, price almost always goes to the target, which is something that we almost never see. So this is a very good sign because his winning trades go almost always to his target. This is great. It could also mean that his targets are set a little bit too conservative because when price is having such an easy time to reach the target, maybe there's even more room. Maybe he could extend his targets a little bit. 10%, 20% could already make a huge difference in his bottom line. But there's more. And what we see here, the red bars are very, very small here. The average drawdown on the winning trades is minus 38%. This means on his winning trades, the price only goes 38% against him. Typically, this is a much higher number. And this is a really good finding because it shows that the winning trades, they work right from the start and they almost never or just barely go against him. Of course, there are some bars where the market goes against him more, but on average 38%. This could mean the trader could experiment with also a smaller stop loss. What happens if you reduce your stop loss size? Of course, some of the trades that previously were winners will turn into losses, but on the other hand, your reward to risk ratio on your winners will increase significantly. So now he can work on both. He could think about moving in his stop loss and making it tighter a little bit while extending his targets. This has to be done very, very carefully and gradually. Ideally, also, you can do it with your alternative strategies. We made a video on using the alternative strategies on our YouTube channel. Make sure to check that out, especially this trader whose journal this is. But if your data looks similar, try it out. See how your performance would change with a smaller stop and a wider target. Now let's change to the losing trades, and let's see what the losers do. And this is another fascinating finding. The numbers are pretty much switched here, right? Average updraw 35%, average drawdown 98%. So it means that here, this is fascinating. On his losing trades, the price doesn't move in his favor, very rarely, only 35% on average. Of course, there are outliers. Sometimes the price almost makes it to his target, but focusing on the majority, on the average here, this means that his losers fail almost right from the start. There's maybe a little bit here there where the market is moving in his favor, sometimes, maybe even sometimes halfway to its target. But on average, the losing trades don't work out at all. So this is a very, very good sign that here we are onto something when the data is so clear. So the data really shows that you are not going to miss out a lot on if you manipulate your stops here. Moving the stops a little bit tighter in, as we have seen on the winning trade side, is probably going to have a huge impact. The area of concern is really trying to get the reward to risk ratio up because that's what's going to smooth out the equity graph. We can actually do that, right? Let's do that. Let's go to the strategy lab and the simulator. So we want to change the numbers. And currently what we see is we have the 43% win rate. Let's start a simulation. Maybe let's just do 200 trades and let's do 5 simulations. So how it's going to look like. And this is the problem. This is now over 200 trades into the future based on the win rate that the trader has and based on the reward to risk ratio, which is here 1.3, right? We saw that in the home tab. And the further apart those lines are, the more noise and the more inconsistencies there's and the more uncertainty. That's a huge, huge problem. But let's say we now improve our reward to risk ratio. Let's say our average gain is going up. Let's say, what does this do? We are at 1.5. That's okay. We are going from 1.3 to 1.5. You can see now the graphs are a little bit closer together, right? They're still quite far apart and there could be here. Now we have outliers to the top, but we also see it's still possible to underperform. So 1.5 is better, obviously, but it's not great. Let's say we are able with our take profit improvements to get it up to almost 1.8. And let's say at the same time, we're able to reduce our average losses just a little bit. So we go to 1.9. And now you can see what an impact this has. Now all the graphs are in positive territory. There's no line that goes under 0 here or that goes below where we started after 200 trades, right? No matter how often I click, I'm sure. Of course, there can be periods where we are here below the starting area. And there is a scenario where even with the 1.9 reward to risk ratio, this is not working out, but it's almost always. So let's refresh and let's see again what we had in the beginning. So 200 trades on 5 simulations, right? 1.3, 43% win rate. That's his current performance. Of course, there are some simulations where we end up above 0, but there are many, many where we are below 0. And it's just a lot of uncertainty. So as you can see, we go from 1.3 even to 1.5, 1.6. We see a big, big improvement and the uncertainty is reduced significantly. So this is hopefully an interesting review. I think the path for this trader is pretty clear. The data here is very obvious. It's a super nice journal. He does have screenshots. He does have sessions. We don't want to go into those things here during this review, just because we don't want to reveal his edge and maybe there's some personal stuff in there. But overall, the big takeaway that we have is that the better maintained a journal is, the more notes you take, the better your screenshots are, the more organized your journal is, the better the performance. This is one thing that we can say with absolute confidence after running Edgewonk for 10 years. The better your journal, the more organized it is, the better the trading performance and the better the chances for the traders being successful. So take this as a good example here for your trading. Take a look at your data and let us know in the comments what you think of this review, and let us know also what your greatest takeaway from using Edgewonk is.